like I said, consumption is all about spending on goods and services. So consumption can also be classified as spending on durable goods and non-durable goods. So why do we call them durable goods? We call them durable goods because these goods can last for more than years, for more than a year. That's why it's durable. Like they can last longer, like cars, houses, buildings, equipment. They can last more than a year. So when you spend on them, it is still consumption. Then we have non-durable. These goods are goods that are expected to be used up as soon as now, or they have a short period of time to
Like
be
food.
used, like food. Yeah. So these are the difference between durable and non-durable goods. But whatever the case might be, spending on them, either durable or non-durable, is still consumption. Is it clear?
Mhm.
Any question about consumption there?
Mhm.
Good. So that takes us to saving. When we save, it means the amount of money that we didn't spend. That is what saving is about. Do you get the point here? So saving is what? I go saving. This is what is not spent on income. So the amount of money you have that you didn't spend on consumption is called saving. I think saving is clear. That takes us to disposable income. Why do we call it disposable income? Because whatever we consume, we can't consume without income. So our income, the level of income is determined by, the level of consumption is determined by the level of income. So that's Keynesian theory of income anyway. So we won't talk about spending without talking about disposable income. So what is disposable income? Disposable income is that income after tax. Any income after tax. That means you've paid your taxes. So the income that is left is called disposable income. So a disposable income is that income that you can either spend or save. Is disposable income clear there? Good. So that takes us to consumption function. Consumption and disposable income. Are you there?
Yes.
So when I talk about consumption function, I wrote, this is the relationship between consumption and factors that determines how much a household can consume based on the level of income. So that is what consumption function is. The relationship between household income and that means the extent to which they can consume based on their income. That is consumption function. Do you get that? So for consumption function, we have the marginal propensity to consume, which is a change in consumption over change in income, MPC. Are you with me, please?
Yes.
So here I wrote MPC this is for marginal propensity to consume. I wrote this is the proportion of a change. This is the proportion of a change in income that is spent. The proportion of a change in income that is spent. So that is why MPC is change in consumption over change in income. So as soon as your income level changes, the consumption is expected to change. Did you get that?
Yes.
So MPC is change in consumption over change in income. Change in consumption over change in income. So where C is consumption and Y is the level of income. I think that is clear. Have this please. So we have average propensity to consume, APC. For average propensity to consume, it simply means the average amount of money spent on consumption as part of your total income. The average amount of money you spend on consumption out of your total income. That is APC, average propensity to consume. So the formula for APC is consumption over income. That's APC itself. But for marginal propensity to consume, it is change in consumption over change in income. But average propensity to consume is consumption itself over income. You get the difference here, okay? So then we have the Keynesian. So I wrote here, the Keynesian theory of consumption states that income is the most important determinant of consumption. So the Keynesian, they believe we won't talk about consumption without income. So income is the most important determinant or factor that leads to consumption or leads to consuming or spending. So according to the Keynesian, as income grows, households would prefer to save more, which means the APC will decline. So according to Keynesian, as soon as your income level increases, you tend to save more. Then because you are saving more, then your average propensity to consume would decline, would reduce. Because your APC is the average amount of money you spend in your total income. Now that your total income is increasing, you spend less. That means your average propensity to consume will decline. Do you get the point there, please? Okay. Also, higher income earners save more of their income than poorer households. Therefore, redistribution of income from higher income earners to lower income earners through taxation may increase consumption. So for consumption to increase, it would have meant that there's redistribution of income. from high income earners to low
Low
income
income
earners,
earners.
and that means through government taxation, maybe progressive tax. So that reduces the gap between the rich and the poor. And as soon as there's redistribution of income, then spending would increase, because poor income earners, they spend less. They spend more on consumption, and they can only spend more on consumption if they have access to more money. So that means income has to increase for them before they would be able to spend more on consumption. But as soon as the gap between the rich and the poor reduces, spending or consumption increases in the economy. Is it clear? That means, so we'll go to other influences now. So that is about income, but income is not the only reasons why people spend. There are other reasons why people might be able to spend. So one, so aside income, there are other factors that determines or influence consumption. The first one here is interest rates. I want to talk about interest rate. Interest rate simply means the price of borrowing or the benefit of saving. So I wrote interest rates. Households rarely finance expenditure on non-durable goods, whether they could borrow on durable goods such as cars, furniture, kitchen equipment. So households, individuals would not borrow money because they want to buy food. They would rather borrow money to buy cars, equipment, office equipment, or kitchen equipment, furniture. They could borrow money to do that. Yes or no? Good. So an increase in the interest rate increases the monthly repayments on these goods. So this means the price of goods have increased. Therefore, households' reaction will be to reduce consumption. So an increase in interest rate will mean that prices on goods will increase. So therefore, consumption for those goods would reduce. So an increase in interest rate will bring about a fall in consumption. Do you get the point there?
Yes.
Also, a rise in interest rates reduces the value of stocks. Why? Because businesses and consumers will cut back their spending, which makes stocks not interesting to households. So another point here is that because the interest rate is increasing, it means the value of stocks would fall. Why? People will not have that amount of money to buy it. Do you get the point I'm making here?
Yes.
If interest rate is increasing, people will spend less. So an individual that is spending less would not want to invest in stocks, in shares. So that means the value of stocks would what? Do you get the point here? Businesses, consumers will cut back their spending, which makes stocks not interesting to buy. So people will not want to buy stocks because they don't even have money to spend on consumption.
Let's alone stocks.
So let's talk about stocks. So that means the demand for stocks would reduce. That means the value of stocks would reduce. Do you understand? So an increase in interest rate would reduce the value of stocks and shares. Do you understand? So that means consumption is reducing. Any question about that?
No.
Okay, so that's another factor that determines consumption, which is interest rates. So for interest rate, we talked about a rise in interest rate. An increase in interest rate will bring about a rise in price of borrowing, which makes consumption to fall. An increase in interest rate also reduces the value of stocks, which means stocks will not, or the value for stocks will fall. People will not be interested in buying stocks. Another factor that could determine consumption is consumer confidence. I want to talk about consumers' confidence. We're talking about what we think about ourselves in the future. So if consumers feel that in the future their situation will be better, then they can maintain their spending or increase their spending. But if they find out or figure out that in the future their situation is going to get worse, they would rather not spend. They would rather save than to spend.
Yes.
So what are those things that we talk about when we think about the future is getting better, like, or your situation will change in the future? Oh, maybe next month I'm going to get a job because I already have my employment letter. I'm going to start working from next month, so my situation is going to change from next month. Then I can spend more now because I know I'm going to start making money. But if I know that I'm not going to have job, I'm going to be out of job next month, then I would cut my spending. So that's confidence. So your confidence you have, if the confidence level you have increases, your spending would increase. But if your confidence level falls based on the fact that you're not certain about your situation in the future, then you cut your spending. So that determines consumption also. Is it clear? Then the next one is wealth effect. So for wealth effect, I wrote. This measures the changes in consumption due to changes in the wealth of households. So there's wealth effect because wealth can also determine the level of your consumption. And when we talk about wealth, we're talking about physical wealth or monetary wealth. Why do we call it physical? We call it physical wealth because it involves items such as houses, land, cars, furniture. These are physical. Then we have monetary wealth, which are like pensions, life assurance, stocks, shares. These are monetary wealth. Are you with me, please?
Yes.
Okay. So what are the two important ways in which the wealth of households can increase? So the first one is a change in the prices of houses. So if the price of houses increases, it means the value of house will increase. So if the value of house increases, which it simply means house owners will be able to take mortgage from banks. Banks will be able to give them mortgage because the value of house has increased. So if they are not paying, if they are unable to pay back, banks will be able to sell those houses. So that means spending would increase for households.
Mhm.
So an increase in the price of houses increases the accessibility of households being able to get loans through mortgage. That's the first point there, which means physical wealth will increase. Yes or no?
Yes.
Okay.
It's very serious.
It's okay. Now, I quickly have to. I didn't explain some things here. I will just okay. Let me go back to. So a change, okay? Then we move on. So for availability of credit, I wrote. But so there are other factors that could not only the interest rate that determines credit. There's also the government regulations. Government might restrict borrowing. So here I wrote government restriction. So government restriction, for example, imposing maximum repayment periods and minimum deposits. So if there's maximum repayment period, which means there's a specified time you have to pay back whatever loan you take. So that means the cost of borrowing would increase because there's a specified time you have to pay back.
This creates interest.
Yeah, interest will increase. And you know when you have a maximum time, that means you cannot pay. You shouldn't exceed that period of time. So that might discourage you from borrowing. Unlike when you don't have unlimited time to pay back. Do you understand? So restriction about borrowing means consumption would fall. Do you get the first point here?
Yes.
And also if government sets minimum deposits, which means there's a limit to amount of money individuals can save in the bank. So if there's a limit to the amount of money individuals can save, it means money supply within the economy would fall. And if money supply falls, banks will not have that much money to give out. So the flow of money would be restricted. So if there's restriction in the flow of money, then consumption would fall because people will not have access to money. Is it clear? Is it clear, please?
Yes.
Then the next one is inflation. And when we talk about inflation is a persistent rise in the prices of food, goods and services within the economy. So here I wrote, inflation. This is a rise in the general price level. An expected future inflation will increase consumption and reduce saving. However, the effect of wealth might reduce consumption during inflation. So there are two things we have to understand here about inflation. A persistent rise in the price of goods and services. So if it's expected that prices will rise in the future, we want to buy now. We fast forward our buying to buy now. Yes or no? Consumption would increase for now. Do you get the point I'm making here?
Yes.
If it is expected that the price of let's say it's expected that the price of this pen will increase next week, I would rather buy more of these pens now. So that means I fast forward my purchasing. So consumption will increase. That is an effect of inflation. Then there's the wealth effect. Because as soon as inflation increases, the value for money will reduce. Yes or no?
Yes.
So people would rather save than to spend.
Okay, I understand.
You get it? So because people start, so inflation might bring about increasing consumption or reduction in consumption. But there will be reduction in consumption if it's about wealth effect. Wealth effect simply means maybe monetary wealth. We won't want to spend now because the value of money has fallen. So we would rather save than to spend. And one way in which government would try to reduce inflation is to increase interest rates. Because as soon as interest rate increases, people will save more than to spend. The demand pull inflation would reduce. Is it clear?
Yes.
So that's about inflation. Then the last one is the composition of the households, right?
Yes.
The composition of the households. When we talk about composition of the household, we're talking about different households that we have. We have the young, the middle age, and the old people. So how did they spend? It also determines level of consumption. For the young people tend to spend all their money, all their income. Then as soon as they want to start raising a family or buying houses or buildings, they start getting credit to do that. So they spend all their income now and use debts to raise children or buy assets. Is it true?
Yes.
Okay. Then we have the middle-aged people. For middle-aged people, they tend to save more than spend because they will be preparing for their retirement. Do you understand? For old people, they spend more on healthcare and on leisure because they are retired already.
Mm-hmm.
So do you understand the composition of household here?
Yes.
Young people spend more, old people spend more, middle-aged people spend less.
Less.
Is it clear?
Yes.
So that ends consumption. Any question about consumption?
No.
Okay.